Well, good afternoon then, folks, on Monday, the 31st of July, as we look ahead to this week's trading. Economic calendar this week, a little bit to go through. We've got the RBA this week, we've got the Bank of England, and then we have non-farm payrolls on Friday out of the US. We start off today with a bit of a manufacturing PMI out of China. Now, that's looking ahead to obviously the manufacturing sector in terms of kind of the purchasing managers index, but the Chinese central bank are improving or trying to improve situations within the economy. They are looking at targeted measures for different sectors of the economy in order to provide stimulus and boost economic growth. So we're still yet to see some of those measures take place. So slightly negative manufacturing PMI, but I wouldn't worry about that too much just as of now, as they are trying to improve the economy moving forward. I know the PMIs are forward-looking indicator, should I say, but with more measures to come from the PBOC that we have yet to find out. Obviously, those will be replicated, hopefully, once we get around to some other figures. GDP out of the Eurozone, slightly positive. Inflation still continues to push lower, albeit not by that much, not by as much as the central bank would hope. But the central bank did suggest last week that they were going to remain data dependent going forward. Slightly positive GDP figures, inflation still coming down. I don't think it really changes that much in terms of their thinking. They will want to wait and see more economic data filter through in order to make a decision at their next meeting in about 6 weeks' time. So we'll have to keep an eye on the data from the ECB, from the Fed. Obviously, we had the Fed out last week, which again remains to be seen as to where these central banks will go coming up into the future. The RBA, we do have the RBA out, 25 basis point hike to be expected. Inflation does still push lower than that, albeit not by as much as markets or the central bank will have hoped. Still looking at raising interest rates by a 25 basis point hike. Last two interest rate hikes were unexpected. We are expecting a further increase this time, and probably we have to await some forward guidance on what to expect going forward. And we just have a quick look back to last week. We'll go back to the previous week, and we will have a look at CPI out of Australia. Now, this is a quarterly figure, so previous 7%, consensus 6.2, actual 6%, so 6% growth in terms of the same figure from Q2 of last year. Back to the monthly CPI indicator, still remains relatively strong. Inflation rate over Q2, 0.8%. So still a bit of work to do in terms of CPI, getting CPI under control. So we are likely to see another interest rate hike once we get around to it this week. And then any forward guidance on top of that, they will probably want to see how the Q3 figures react. But, do we expect more interest rate hikes after that? We're waiting further forward guidance from that meeting at 5:30. But are they likely to stick to the script of data dependent going forward, as the rest of the major central banks are? I would suggest probably. The Bank of England, we did have an inflation print since their last meeting, which was a substantial drop in the rate of inflation. Now, we are expecting a further 25 basis points worth of hikes from the UK, or from the Bank of England, should I say, at midday on Thursday. Now, again, we need to see some forward guidance going forward as to what to expect moving forward, but some market participants even thinking that the terminal rate will reach somewhere up towards 7%. So with that inflation print a few weeks back pushing aggressively lower, substantially lower from the previous month to 0.2 or 3% below consensus, making progress, but that's a bit of progress, certainly not where they need to be in terms of getting prices under control. So do not expect this to be the last. Certainly I do not, and markets do not expect this to be the last. So we'll have to see what Andrew Bailey says accompanying that interest rate hike, but interest rates certainly not near the end in the UK for the moment. Just now, 25 basis points on Thursday. Again, we need to look towards forward guidance, see what they suggest going forward. But going forward, more interest rate hikes certainly than the ECB and the Fed to come. Non-farm payrolls, important once we get around to it. On Friday, labour market figures will be important when it comes to deciding whether the Fed will continue to hike interest rates or not. Now, we do have the Fed from last week out of the way until the 2nd of September, so there are 2 NFP prints and 2 inflation prints waiting to come until we get their next meeting. So something we need to keep an eye on once we get around to it. Inflation yet to come. We did have PCE last week from core PCE, which came in at 0.2% in terms of the month-over-month figure, which is a more normal rate of inflation. That would be 2.4 if you extended it over the course of a year. So that more normal in terms of the Fed's preferred metric of inflation. Still a bit of work though that needs to be done in order to cool down inflation. And if the employment market, if the labor market keeps strong, that is likely to continue to put a bit of upside pressure on prices. So non-farm payrolls, the Fed will probably want that low, and consensus for it to beat consensus or come in above consensus, come in above this 3.6% level for the unemployment rate. Now that if that does come below 3.6% and the unemployment rate ticks down, well, that means that the Fed still have more work to do, and that may ramp up bets around further interest rate hikes to come from the Fed at their next meeting in September. So those employment figures, definitely something that we need to look towards, and any miss on expectations or any lower than anticipated unemployment print should be positive for dollar, negative for stocks. And that brings us over to some charts then, where we have a look at the dollar, which is having a bit of a bounce back across a number of these different currency pairs. Now, US dollar strength last week post Fed, and certainly post that GDP print. So GDP strong last week. Still have inflation a little bit too high, but GDP strong, extremely strong. We had those durable goods orders extremely strong. So strong economic data means that bets are going to ramp up for interest rate hikes. So that's why those unemployment prints, if they come in lower than anticipated, that then means probably US dollar strength to continue. So that's where we're sat at the moment. A bit of a pullback now, but have to keep an eye on it as we go on throughout the course of this week. Now, yields pulling back. 10-year has had a little bit of a retreat from the highs in 2-year as well. If we flick that back up as well, having a little bit of a retreat and a bit of a stall from those highs as well. So a bit of a pullback in yields has prompted a bit of a pullback in the dollar, which has had a bit of a push higher in stocks, and stocks looks like they want to have another bit of a push higher. But oil, I think, is something we definitely need to keep an eye on. This trend continues, right? We were looking at this level down at 67, didn't manage to break, and it's just been a one-way train since. Now, if oil starts to make its way back up towards 85, towards 90, that puts upwards pressure on inflation. Right, upwards pressure on inflation is not what central banks want, and oil, the prices of oil will drive that. Now, OPEC are trying to prop up prices of oil. They're trying to remove supply in order to keep money going for their countries, which from their point of view is pretty understandable. Obviously, they want to make as much money as they possibly can. The fact that this continues to push higher is not good for inflation, and if economic data that continues to surprise to the upside, that continues to put pressure on inflation. Oil higher continues to put pressure on inflation, and that will not be a welcome development for the central banks. So continue to keep your eyes peeled on oil. The trend is higher for now, and as long as it remains in place, you have to remain a buyer of oil, especially when they are still cutting production of oil in order to reduce supply. And demand, with economic data still remaining strong, demand for oil still remains good. So reduced supply, similar demand, or even increased demand causes the price to go up. If these measures in China boost economic growth in China, well, that will put further upside pressure on oil as well, and that is not good for inflation. So this oil chart is probably one of the most important charts in markets at the moment. Equities across the board higher today. They continue to push higher. The DAX continues to reach fresh all-time highs. The Euro Stoxx continues to reach fresh all-time highs. US stock indexes look like they want to make another attempt higher. We got the Fed out of the way last week, not got that event risk. Yeah, I mean, you have to remain a buyer. The trend is higher. Markets keep buying stocks, but if economic data keeps surprising to the upside and oil keeps trending higher, it means the Fed will continue to hike interest rates, and that could get a little bit messy. But for now, stay on the long side, but there are some risks to that uptrend coming along. First of them is oil. Second of them we'll see on Friday after NFP. But a few data releases to keep an eye on over the course of this week, and we will be sure to update as and when they come.